Hello, this is Ken Shilson, and I hope everyone is staying safe and is well during this pandemic. I'm sure all of us are ready for the pandemic to end and for your subprime operations to recover and for you to be able to capitalize on the opportunities that lie ahead. That's going to take capital, and getting the capital that you'll need to be able to grow and prosper again is what I'm going to talk about during this presentation. So let's get started by talking about what subprime capital providers are looking for. In talking with them and working with them, there are 10 things that subprime capital providers are looking for today. First, they want good financial partners that have credible metrics. I'm not talking about a compiled financial statement or a tax return, but I'm talking about portfolio performance metrics that will show how you're really doing. And a good financial partner is one that is invested with enough equity in their company and will work positively with whoever is loaning them the money. They're also looking for good internal cash managers. What do I mean by that? Well, first, that you've eliminated all the non-essential expenses and that you're devoting all your capital to those expenses that are going to increase your profits and increase your cash flow and eliminated everything else. So being a good internal cash manager is extremely important if they're going to be providing the capital for you to be able to grow your portfolio and your business. Number three, they're looking for a prudent strategic business plan. How are you going to differentiate your operation from your competition? It's going to be very competitive looking for capital out there. So how are you going to stand out? How are you going to prosper in the days ahead, in the market ahead? How are you going to do better than your competition? That's what they want to see in your business plan, as well as how you're going to deploy the capital and what your game plan is to be successful in good times and in bad. They want efficient systems and processes. Why is that? They're looking for solutions to business challenges that they know are going to come up, and they expect that you're going to have the systems and the processes and the people in place to be able to solve those challenges successfully. They want to see a competitive market niche. How are you going to thrive against your competition in areas where there are a lot of other dealers close to you? How are you going to differentiate yourself from them? How are you going to get the business? How are you going to keep the business? Those are important aspects of having the right business niche. And the next item is equity in your business. I can't emphasize enough how important it is to have enough equity in your business to give you the financial flexibility that you need to be able to withstand any uncertainties in the marketplace. They look at the amount of equity that you have as to how invested you are in the business and how much flexibility you're going to have if certain surprises occur in the future or certain challenges come up. Credible performance metrics and a cash-efficient business model. You can't look at your financial statements and tax returns and really tell how efficient your business model is. You have to weigh how much you've invested to build your portfolio from a cash standpoint, and then how much cash you've gotten back and you're going to get back after adjustments for your historical loss rates. That's going to require metrics, and that's going to require you to make a return on investment calculation. More about that in a few minutes. They want an experienced management team, a team that can thrive in both good times and bad times. And that experience really makes a difference. A group that's worked together for a number of years, that's worked successfully and has a proven track record is very important to them, because they are investing in the future not only of your business, but in all of your personnel as well. And your personnel are your most valuable assets. Technology to provide business solutions. Again, you're going to have to make more from less. So implementing technology to be more efficient, more profitable, more effective is the key to that. And clearly they're going to be looking to your technology to be able to monitor your business, not just your dealer management software system, but all the other tools that link to it and provide solutions to the many challenges that you're going to have in your business is what they want to see. So this is the time to embrace technology, not reject it. And the good news is that technology in the subprime auto business has never been better. There's tools everywhere to help you be more efficient. Learn what they are and implement them successfully into your own business. And finally, number 10 is having a compliance management system. I can't emphasize how important that is. This is not the time to let your compliance guard down. It's important to know that while the CFPB is no longer as active in the enforcement area, they've passed that chore to the state attorney generals. So you're now on a smaller radar screen. And as the pandemic subsides, the state AGs are going to be more aggressive in looking under the hood of operators, particularly when they get complaints. So have a compliance management system under the direction of a chief compliance officer. Make sure that you know that the system is working. Make sure that the people that are working for you understand how to implement it properly, and make sure that you're on your compliance game. They don't want to see a regulatory investigation that's going to be very debilitating and costly. So have a good compliance management system in place. Have your contracts reviewed by a capable attorney and have him give you an opinion that they're compliant. Well, let's talk about how COVID-19 and the pandemic has impacted the subprime auto finance business. And there's been some positive things and there's been some negative things. And I want to go through first the positive things that we've learned from the pandemic. Although the impact on individual operations varies significantly by state, depending on the regulatory restrictions that were placed on dealers and whether their operations were deemed to be essential businesses or not. Generally, dealers have reported good sales results in May and June and excellent collections in quarter number 2. I think that's a surprise to most people who predicted that when the pandemic began, that subprime customers were going to have a difficult time paying for the vehicles that they already had, and certainly being unable to buy another vehicle. Well, let's talk about what really happened and why these results have been much more positive than what was expected. First of all, subprime customers need affordable transportation. And the subprime auto finance market, buy your, pay your dealers, provide that transportation to them. New vehicles, which average cost today is $40,000, if you're buying a truck or an SUV, it's $60,000 or $70,000, is simply unaffordable to the average American today. So there's plenty of customers out there that realize that transportation is important for them to get back and forth to work and to live their daily lives, and they've prioritized it accordingly. Number 2, and I can't emphasize how important this has been, is government stimulus that's helped prop up the economy during this challenging time. Some of those consumers received a $1,200 stimulus check and also received an additional unemployment benefit of $600. So in reality, with the stimulus check and the unemployment benefit, they in some cases had more cash flow being unemployed than they did when they were employed. And they've used that money to keep current on their payments and to prioritize their car payments in the highest order. So that's helped with collections, and some of those people have used those stimulus checks and down payments and unemployment benefits to make down payments on vehicles, which has helped originations. Another item has been the change that has occurred in the securitization market. Wall Street has flooded billions of dollars into the subprime auto finance space over the last 4 or 5 years by mixing pools of loans, subprime and deep subprime, with better quality loans and selling them off to investors with the promise of a high return. Some of those deals have not worked out, and investors have not been satisfied in all cases, not in every one, but in all cases, with the returns that they've been getting. As a result, Wall Street has shifted from subprime and deep subprime securitizations to more prime and near prime. There's still some securitizations going on, but they're much less than they were before. That's good news for independent dealers because it means less competition. Less competition from new car dealers who are benefiting by these securitizations, or from finance companies who are aggressively penetrating the market and buying deals that otherwise would be available to the independent operators. And finally, more consumers are likely to enter the subprime market due to a decline in their credit rating. Maybe they've lost their jobs, maybe they've been temporarily laid off or furloughed, perhaps they've had some other challenges that have come up. So as a result, some of the higher credit quality customers are going to come back into the space and be available to independent dealers to upgrade their portfolio. So those 5 factors have all been very, very positive and had a positive effect on the market. The question becomes, what's going to happen in the future? So let's talk about some of the negatives that also occurred. The first is stay-at-home orders, which impacted originations in Q2. Obviously, if you're an operator who was forced to be closed because you were not deemed to be an essential business in your state, it adversely impacted originations. You can't sell vehicles unless customers are able to come onto your lots and buy them. So stay-at-home orders have definitely impacted the flow of customers and in some cases the ability to stay open. The duration of the pandemic may adversely impact subprime collections in the future. As I just mentioned, stimulus checks and additional unemployment benefits have helped with collections and in some cases originations. Unfortunately, the supplemental unemployment benefits expired in July, and it's unclear whether a second round of stimulus that will be equal to the first round is going to occur. It's very likely we will have a second round of stimulus, but that money may be less than it was in the first scenario. So clearly, how long the pandemic lasts and how the impact of the reduction in stimulus payments and the loss of additional unemployment benefits may affect your customers' ability to pay is of concern to the capital markets, and it should be a primary concern of yours as well, that uncertainty. As a result, the capital markets have definitely tightened up. Look for them to be much more diligent in onboarding new business, to be looking tougher at your competition and how you really stack up, and whether or not they deem you to be worthy of borrowing money in the future. That's also true of renewals. Maybe you have a line of credit, but don't expect that your capital is all automatically going to be renewed at the same rates and for the same amounts with the same advance rate. Don't take that for granted. Number 4 is the pandemic has definitely changed the attitudes of customers about the time they want to spend in your dealership. What I mean by that is they're now getting used to not only buying vehicles online, but actually closing the deal online, the whole process there. Yes, they may still come into your lot briefly to do a test drive or to see the vehicle, but they don't want to spend 3 or 4 hours there waiting to document the deal. So clearly, those operators who have adjusted and have a social media presence and an online presence have fared better than those that haven't. Look for that change to be a permanent change going forward. Make sure that you have the ability to not only sell them a vehicle online, but to close the deal and do all the paperwork online as well. it'll pay big dividends for you in the future, and your capital providers will be impressed by that type of system and process and that expertise. And finally, inventory has been very scarce, and as a result has been more expensive. Why? Well, first, many of the auctions were closed down for a period of time during the second quarter. And when they did open, there's been less repos going through, and there's been less flow of the type of vehicles that you may be looking for. As a result, the vehicles that are there have been more expensive. I look for the inventory flow to change in the next few months. We're going to see more off-lease and off-rent vehicles. Now, for the buy-here, pay-here space, those vehicles aren't really the fit that you're looking for. But if you're in the retail business, there may be some great opportunities to get some low-mileage vehicles that the rental companies who've been forced to cut back are now dumping into the market. And certainly there's a big supply of off-lease vehicles, of which those off-lease terms have been deferred while the pandemic has been going on in the second quarter. So there is going to be a greater flow of vehicles, and I do believe that prices will stabilize. Inventory is still going to be a challenge to find the right inventory for your operation. Well, let's talk about where is the capital going to come from? Who are the auto finance companies? And I'm going to provide you with lists and contact information. But first, you need to divide the capital providers into two groups. And the first is direct capital providers. Those are the players that are going to provide money directly to you. And the first is regional banks, and that includes national banks that may also have regional branches. These banks, particularly those that have been in the asset-based lending program for a period of time or been loaning to buy-here, pay-here operators over the last several years, and I'm going to give you a list of those, are likely to be the lowest cost choice for finding a line of credit. Then there's non-bank finance companies. Those are private equity firms, hedge funds, and unregulated financial institutions who typically want to provide capital to the subprime auto business. Unfortunately, the cost of their capital is higher than what banks and regulated financial institutions have. So you must expect that the rate that they're going to charge you for that capital is going to be higher. But they're going to be less stringent in terms of what restrictions they're going to place on you, what covenants, and some of the other details of the loan agreements. So clearly, non-bank financial companies are important, and I'm going to give you a list of those. I mentioned earlier how difficult it's been to find the right inventory at the right price. Well, you need a floor plan to be able to take advantage of those opportunities as they arise. When you find the vehicles, you got to be able to buy them. So I'm going to give you a list of floor planners out there that can help you get the floor plans that you need to acquire the vehicles as they arise. Maybe you haven't sold any contracts in the future, but in the months ahead, maybe you need to supplement the capital that you have available to you with the sale of some contracts. And I'm going to give you a list of contract purchasers and their contact information so you can find the right match for your own portfolio. And finally, maybe you don't want to sell off a block of contracts, or you maybe don't want to sell the whole contract, so you want to sell just a stream of payments. Payment streaming is something that's been popular in the past as a bridge for dealers that need short-term capital. So payment streaming may be a solution if you don't want to sell off a block of contracts or sell off the entire contract itself. And operators like Small Dealers Assistance, Car Financial have offered payment streaming options in the past. So it's something to consider if you're not familiar with it. The first list that I'm going to show you, these are people that typically will provide lines of credit. And some of them are regulated financial institutions and banks that I was explaining before, and some of them are unregulated financial institutions or specialty finance companies that will provide capital to the subprime auto industry. Both are important, and it's important to match the capital providers on this list against someone who you feel will be a good financial partner for you and will provide the capital that you need going forward, both in good times and bad times. And all these players have been in the business for a while. They understand it, and they've got the staying power to get through the challenges that may lie ahead. A program that you're not familiar with but could be very important to the subprime auto business is the Main Street Lending Program. If you're not familiar with this, the Federal Reserve has carved out $600 billion in which they plan to repurchase up to 95% of some of the loans that banks make to encourage them to loan to businesses that might be considered more risky than banks would normally do. And certainly the subprime auto business could fit into that higher risk category. And if we can tap into the Main Street Lending Program as a source of the lines of credit, or a possible source of lines of credit, this could be a great solution. More about that in the future as we work with the regulatory bodies and the Federal Reserve to see if we can structure something that will work for automotive dealers and particularly for independents. So stay tuned, because there's a huge block of capital out there. The way to find out about it is talk with your local bank. Your local bank or your national bank will be the ones that will be able to link into the Main Street Lending Program, and they will have more information on whether you may qualify for one of those types of loans. I mentioned earlier how important floor plans may be. And here's a listing of floor plan providers, large and small. The largest floor plan provider in the industry is, of course, NextGear Capital. AFC is also a very large floor planner, as is Ally with their Smart Auction program. But all of the items, all of the entries on this list are people that have provided floor plans to independent dealers in the past. So find the floor planner that matches best with what you're looking for. Also, some of your local banks and regional banks and national banks will also provide floor plans in addition to lines of credit. So there is money out there if you're looking for a floor plan, and that's going to be important as you seek the right inventory for your business in the future. This is the first of 3 slides. There's a tremendous number of indirect auto finance companies who will buy contracts either point of sale or in bulk. And this is the first of 3 slides, and I've listed their contact information. You're welcome to go on the internet and Google them. But what I would suggest is that there's plenty of alternatives out there. But finding an alternative that best matches your portfolio is what you want to do. Here's the second screen, and as you can see, even more capital providers. And again, they all have different programs, so finding the right one to match what you're looking for is very important. And finally, this is the third slide. Again, there's even more finance companies out there that purchase contracts, so it's not hard to find someone who is going to be interested in acquiring this paper, but you have to figure out which one's going to provide not only the best price, but you'd like to have an ongoing relationship with them, someone that you can go back to in good times and bad times. I think that's very important, what we call a flow. Developing a flow with them is going to put you in better stead than just one-off type transactions. So building a relationship with all your capital providers is a very, very important aspect of having a successful relationship going forward. Well, what if capital providers say no? what if you can't deliver all the things we talked about previously, or even if you can, maybe the capital providers that you're talking to, for whatever reason, say no, we don't want to lend the money. What do you do? What's the next course of action? Well, first of all, you need to have a realistic approach to the market. If they say no, don't get angry, because if you borrowed your way into the pandemic, you should not expect to borrow your way out of it. What do I mean by that? If you were fully leveraged when you went into the pandemic, there may not be an ability to borrow more money coming out of it. So as a result, don't be offended by it, but learn from it and take the necessary steps to get into position where you can get the capital that you need at the right price. So what can you do? Well, first of all, you've got to increase your internal cash flow. And that starts by making more from less. You've got to have technology in your business. You've got to be operating lean and mean. Your people have to be efficient and effective. And you have to simply process more transactions with less cost. You've got to have a good internal cash management system. Again, that means eliminating all the non-essential expenses and spending every dollar like it's your last, because capital is going to be in short supply, and clearly you've got to make every dollar count. Your cash and your business model has to be cash efficient, and it has to generate a positive return on your investment, but one that's commensurate with the risk that you're taking. And clearly you need to know what the return on investment is on a cash basis, loss adjusted, and we'll talk a little bit about how to do that in a few moments. You need to compare your operating performance with industry benchmarks. For the last 21 years, I've issued industry benchmark reports, and the banks, financial institutions, Wall Street, and many in the industry are using it as a comparative tool to see how you stack up against your competition. You should be using it to understand what your competition is doing and how your performance stacks up as well. You must avoid trial and error mistakes and compliance mistakes that can be very expensive. They can cost you millions of dollars, and they're very debilitating. So don't keep making business model changes unless you know that they're going to have a positive impact. You do that by analyzing your portfolio. Get on your compliance game. Have a compliance management system and make sure that it's working properly. And most importantly, if you have a customer complaint, try to settle it before it becomes a litigation matter or before the state attorney general gets involved. That's extremely important. It's going to be the most cost-effective way to settle compliance issues. Develop a strategic business plan. What do I mean by that? Well, a capital provider wants to know what you're going to do with the money if they lend it to you, how it's going to generate more cash flow, more contracts, more collateral, and is going to make you more profitable and more successful. You need to know the answers to all those things when you talk to them. So they're looking for a business plan that's going to differentiate you from the competition and be a sound plan to be able to be more successful in the future if they give you the capital that you're looking for. And an important aspect is to recognize the market changes and adapt quickly. Well, how do you do that? Through training and education. It's never been more important to have training and education today so you can understand what's going on in the marketplace. You can understand what others are doing. You can understand what's working and what's not working, and you can make those changes in your own business. And you have to do that as swiftly as possible before you burn through a lot of precious capital that you're going to need to be successful. Well, how then do you build positive relationships with capital providers? I hope when I give you this next slide that you'll remember the 4 C's. First, communication. And that starts now. if you're going to need money in the future, you need to start early and communicate with prospective capital providers. You need to build the relationships. And that communication is so very important when you're looking to borrow money. So clearly, communication prior to borrowing money is as important as after you borrow it. Capital providers don't want any surprises, and you don't either. So clearly, you have to communicate the good things that are happening in your business as well as any problems that you're encountering. That's part of being a good financial partner. So clearly, have good communication lines with prospective capital providers and with existing capital providers. Collateral is so important because that's what they're looking at as a source of possible repayment for the lines of credit that they're making to you. So this is a time to make sure that you have good collateral under your contracts. It's not a time to load up your portfolio on a bunch of recycled repos. So clearly, build a strong collateral base that will serve you in good stead, either in renewing your lines of credit or in getting new ones. Cash flow. I mentioned earlier how important it is to make every dollar count and to preserve capital and spend it on areas that are going to increase and bring more cash flow, more profitability, or to pay back debt. And finally, compliance. Once again, having a compliance problem is very expensive and very debilitating. So you need to be on your game. It starts with having a chief compliance officer, and it continues with having your contracts reviewed and making sure all the disclosures are there, making sure that your customers understand what's required of them and vice versa, and clearly avoiding misunderstandings and complaints that can escalate to the attorney generals and lead them into your operation. Avoid surprises and be proactive. These things don't happen. The 4 C's has to be done proactively. Well, what things should you avoid when prospecting for capital? As I work with and talk with capital providers, I see 10 things that are absolute deal killers. And I want to share them with you because if you do these things, it's unlikely that you're going to differentiate yourself from the competition in a positive way. First, say that you have an all-new management team. Remember, I told you that experienced management teams and groups that have worked together for many years and solved challenges and have a track record to show it is very important to a prospective lender or even to a lender that renews. They don't like to see a lot of turnover, a lot of new faces, a lot of unproven talent. So clearly, keeping your management group together and working together cohesively is very important. To ask how quickly they can wire the funding. Desperation is not a good thing, and that sends a message that you need the money today to pay the bills tomorrow. That's the last situation that a capital provider wants to get into. So clearly, you have to start early, and you have to be patient for the due diligence to occur, for the documentation to get done, and to prove that you're not borrowing your way through the next challenge. You need a compliance system that's not just based on the forms that come out of your DMS provider. Yes, it's important that you use the right forms, and the DMS providers generally provide those to you, but you have to be doing the things that are contained in your contract. So make sure that that your systems and procedures match what your contracts say they're doing. And clearly, that requires you to have systems and processes built around those forms and procedures in place to make sure that they're happening. Having vehicle sales data but no performance metrics. It's fine to tell someone I sold this many cars last month or this week or even have a goal for what you're going to sell each month, but that's not sufficient. It's keeping them sold that capital providers care about. Selling a vehicle is just the first step, not the last one. So you have to have metrics that show that those deals are going to stay on the books, the cash flow is going to come in and be available to repay any debt that you borrow. Number 5, demanding a higher advance rate. Certainly, you have an idea of what advance rate that you need to fund your operation, but let the due diligence occur, build a relationship before negotiating your advance rate. And remember that having a higher advance rate isn't necessarily a good thing, because debt has to be paid back. And clearly, the lower the advance rate and the more equity you have in the business, the more you're going to be able to withstand any uncertainty that's out there. So have a reasonable expectation with regard to your advance rate, and look at your business model to make sure that you can live on that. Saying that you're about to change DMS systems, that's death, because your capital provider is going to need to be able to access the information in your DMS system to monitor your business and to monitor the line of credits that they provide you. So clearly, making a change in your DMS system is going to delay your ability to add capital. And you need a good DMS system that provides the reports that they're going to need to be able to support your line of credit. Saying that you don't have financial statements, but you do have tax returns. Financial statements are important not because they're an accurate barometer necessarily of how your business is doing, particularly unless they're GAAP basis financial statements and they have life of loan loss reserves, and many operators in the business don't have either of those things. Clearly, financial statements, though, indicate to a capital provider that you're reconciling and closing your books on a periodic basis, and that is important to them. So financial statements do have some value, but not necessarily as a barometer to manage your business. They're just one element of the financial reporting that you're going to need in a line of credit relationship. Get to the next slide here. There we are. Not having written procedures for underwriting and collections because you say you're too small. Maybe you don't have a huge operation. Maybe there's limited people inside your operation processing transactions, but you still need written underwriting and collection procedures. Those are required under a compliance management system. Those are required whether you have a regulatory investigation. So clearly, you can't use as a defense that you're too small and you don't need those. Lenders and capital providers want to understand what your underwriting and collection procedures are because they're betting on those for your future success. Making significant changes in your business model frequently. Every time you make a significant change in your business model, and let's say, as an example, instead of selling a $10,000 ACV vehicle, you switch to a $5,000. That changes all the performance historical metrics that you have. So capital providers will want to see a reasonable base of data supporting the business model that's in use. Yes, you can make some subtle changes and tweaks to it, but when you make major changes, it destroys all your performance metrics. And finally, it's important that you write off bad debts when they're known. They're not like a bottle of wine. They don't get better with age. Recognize your losses as they occur and where you know them. That'll allow you to track the trends properly and to get them behind you. Clearly, deferring your losses only makes it worse. So write them off, and if you write them off but you haven't recovered the vehicle yet, you can book the recovery after you write off the bad debt. So you'll be able to bring that recovery back into income, whether it's at the time that you write off the bad debt or not. Very, very important. And capital providers are going to hold you to that in making sure that you have a policy of writing off your bad debts and that you follow it. Business model is extremely important to capital providers. Why? Because that's the largest use of capital that you have available to you, and they're looking for consistency. So make sure you have a cash-efficient business model and measure that by how much it's cost you to build your portfolio and how much cash you've gotten in plus what you're going to collect on a loss-adjusted basis. The latest benchmarks will be released at the NIADA virtual conference on September 22nd from 1:30 to 2:15. We're going to have a panel of experts giving you all the latest information, and you're going to be able to get a clear picture of what's happened since the beginning of the year and since we did the 2019 benchmark report, which is available through NIADA and probably through your state association. So get both of those. Look at the latest benchmarks, but get a copy of the 2019 benchmarks report and make sure you compare that against your own operating results. And if they don't match up, you need to think about why they don't match up and what you need to do to get them to align. It's important you understand what your competition is doing, and it's important to understand what you're doing. How do you compare with your industry peers? Well, in order to understand, you have to compare the ratios, which will show your financial ratios on your balance sheet and your income statement, so you can see how you stack up financially with your peers. Business model comparisons. What are you competing against? What are they doing? What are you doing? Doesn't make them right or wrong. It just means that you need to be knowledgeable on what you're competing against. 20 group operating information. 20 groups are an excellent source of exchange of ideas and help you keep current on what's going on in the business. So if you're not a member of a 20 group, I encourage you to look into it because I think it can really benefit you. Portfolio performance metrics. Clearly, those are things that I've generated in the past. They're going to be in the benchmarks report. They're going to be updated mid-year. But it's important for you to have your own metrics and to be able to take your metrics and compare those against those that are in the benchmark report. There is other expert commentary in 2019, and there will be in mid-year, talking about the capital markets, talking about compliance, talking about technology, talking about loss information and financial information. These are all things that you need to know and how you stack up, because the capital providers or prospective capital providers are going to use these things to try to differentiate you from the competition. So know what they are, get ahead of the game, have answers for the differences, and justify what you're doing versus what your competition is doing. And finally, market perspectives and trends. I mentioned earlier that there's changes occurring in the market all the time. The market is different in 2020 than it was in 2019. I'm sure we all realize that. But what are you going to do about it? What changes do you need to make? What do you need to do to adapt to be successful in the current environment? What trends are occurring? What is your competition doing? What are best practices that are working? What are practices that aren't working? These are all things that will help you be successful and preserve the capital that you have available to you. One of the most important slides that are in the benchmarks report is this one right here, because it measures your cash in deal. Cash in deal is the money that you're putting on the street. It's the difference between the actual cash value of the vehicles that you're acquiring, reconditioning, and selling, and the amount of down payment that you're getting. So the difference is the cash in deal, and as you see here, I'm pleased to say that our down payments were higher in 2019 than they've been in the last several years. And as a result, we're seeing a lower cash in deal, in part because of the higher down payment, but also in part because operators are paying a little bit less for vehicles and have reduced their costs due to the capital limitation. So something to think about. Look at your business model and see how cash efficient it is, what your cash in deal is, and whether the amount of cash in deal that you have with your business model matches the capital that you have available. It's easy to outrun the amount of capital that you have and sell yourself into problems in this business. The original term, we've seen by analyzing $24 billion worth of portfolios that the term of your contracts is very important. Shorter is better than longer. And what we've seen historically is that customers have only wanted to pay for up to 24 months and then go to get another vehicle. So the longer your contracts, the more back-end risk that you have, the more possibility that you'll have a write-off after that customer moves on to another vehicle if he doesn't buy it from you. So clearly making sure that you keep your terms as short as possible, and you do that by getting more down, higher repayments, and keeping the amount financed at a reasonable amount. Rick Potter, formerly president of Car Financial, said in 2008, if you're not using analytics or metrics today, you're going to have a hard time borrowing money tomorrow. What sage advice that was, because today I don't know of any capital providers that are going to loan you money without having metrics on your portfolio. So I want to spend a few minutes talking about what those metrics are, and if you don't have them, you need to start building the data so that you can get them. There are three fundamental metric measurements that you need to be aware of. The first is static pool loss analysis. Static pool measures the severity in dollars and the frequency in units of losses over the entire life of a portfolio of loans. So here's an example, and I'm not going to go into this example in great detail. I'm just going to say that it's merely a comparison of the lost dollars against the dollars that you book. And I have a video on my website that explains this and tell you how capital providers use it and how you should be using it. And I encourage you to review that website. Static pool is calculated on a net basis after recoveries. It does not include finance charge income because it's measuring the return of capital, not the return on capital. Loss to liquidation analysis measures the pace using dollars of losses in your portfolio during the economic life. The challenge with static pool is that it's most accurate when the pools are fully amortized. But if you have loans that are only a few months amortized or part-way amortized, how do you project what your static pool rate's going to be? Well, that's loss to liquidation analysis, and it's simply the lost dollars measured against the dollars liquidated. Again, view the video on my website and learn more about loss to liquidation analysis. You may hear the term CRR when you're talking to a capital provider. CRR is the inverse of loss to liquidation. So make sure you know what loss to liquidation is and how to use it, and more importantly, what your loss to liquidation rate is. Default rate, that measures the frequency of customer repayment defaults in units, not in dollars, and it's a barometer of the quality of your portfolio. The higher your default rate, the more volatile your portfolio is and the poorer perception of quality that you have. So clearly your default rate does make a difference. It's strictly the number of loss units versus the number of units that you originally booked. Again, an explanation in the videos on my website. Check it out. Well, why do you need these metrics? First, it'll help you increase your cash flow. You can find out what's working, what the trends are, and you can make the adjustments necessary to maximize cash flow. I mentioned earlier it's essential to getting capital. That's what the capital providers want to see. It shows your sophistication. It shows you're on top of your business. Peer performance comparisons. I mentioned the benchmarks and knowing where you stand. Have answers to those things before you talk to capital providers. Identify the loss patterns and loss trends. Make sure that you know how your portfolio is trending. Is it doing better or worse? And find out what's causing it. And that requires you to drill down into the losses and find out what's going. You wouldn't buy a vehicle at auction without looking under a hood of the vehicle. Well, don't build a portfolio and put millions of dollars into it without understanding what's under the hood of your own portfolio. You can use the information and metrics to improve your underwriting and even create credit scoring models, or if you have a credit scoring model, to make the necessary adjustments to make sure you're staying on your game. It's a credible, independent measurement, just like a tax return is or a financial statement is, but it's so much more important because it's actually measuring how much of every dollar that you put on the street you're actually losing. So whether you're holding your portfolio and have a line of credit or you're selling it off and you want to know whether the price you're being offered for your contracts is a fair one, you need to know what your metrics are. And finally, to calculate your return on investment. Clearly, you wouldn't make an investment in any business without expecting and knowing what kind of return that you're likely to get if you make the investment. That's true in this business as well. And that needs to be adjusted for historical loss rates. Again, important to have the metrics to be able to do that. At Subprime Analytics, we integrate with all the dealer management systems, so there's no input required. It's all electronic, and clearly we can take the data right out of your DMS system and use it to give you the metrics we need. For more information on Subprime Analytics or to view those videos that I mentioned earlier, here's my website at subanalytics.com. Make sure you check out the 2 videos on the home page. It'll help you understand the metrics that you're going to need when you're talking to the capital markets. And if you'd like a list of all the capital providers that's been in this presentation, any floor planners or contract purchasers, those slides that I had, all you have to do is either call me or email me, and my contact information is right there. I'll send it to you, no obligation, but I want you to be prepared when you contact these capital providers because it is going to be competitive, and it's important that you think about the things that we've covered today, and I certainly wish you the best of luck. So with that, if you have any questions, feel free to email me, and I'll be trying to respond promptly, or call me at the number shown below. Visit my website so you understand more about some of the things that we've discussed today. Stay safe, stay healthy, recover from the pandemic, it shall pass, and take advantage of some great opportunities that lie ahead in the subprime auto finance business. Thank you very much for attending.